Welcome to the Golden Chronicle. Now we'll tell you a short story about the 2008 financial crisis. It didn't start with a crash. It started with a promise that everyone could own a home, even those who never should have been approved. Wall Street packaged dreams into billion-dollar products, sold them like candy, and built an empire on sand. In 2008, that empire collapsed. Banks froze, markets panicked, and for a moment, the global economy stopped breathing. This is the story of how greed, fear, and broken trust nearly destroyed the world. The calm before the storm, and a world unaware in the early 2000s. The world seemed to be living in a golden age of prosperity. The housing market in the United States was booming. Stock markets were hitting record highs, and banks appeared to be unstoppable engines of growth. Everywhere you looked, people were buying houses, taking out loans, and investing in real estate. There was a feeling that the American dream had never been closer. Home ownership, once considered a carefully planned investment, had transformed into a widespread opportunity for everyone, regardless of income. Banks and financial institutions were eager to lend. They offered mortgages, not only to those with stable incomes and good credit, but also to those who, under normal circumstances, would not have qualified for a loan. These high-risk loans were called subprime mortgages, and at the time, they were seen as just another tool to fuel economic growth. People were thrilled. Families bought homes they could barely afford, believing that house prices would continue to rise indefinitely. Realtors encouraged buyers, promising that investing in property was a safe and guaranteed way to build wealth. Behind the scenes, the banking world was creating even more complex instruments. Mortgage-backed securities, known as MBS, were being sold to investors across the globe. Banks took individual mortgages, bundled them into large investment products, and sold them to other banks, hedge funds, and pension funds. The idea was simple in theory. Spreading risk among multiple investors would make the system safer. But in reality, the risk was not reduced. It was simply hidden. Collateralized debt obligations, CDOs, were even more complex products layered on top of these mortgages, making it nearly impossible for anyone outside a few elite financial institutions to understand the true risk involved. Most people, from homeowners to international investors, believed the system was stable. The media reported stories of rising home values, record-breaking profits, and robust consumer spending. Financial analysts gave optimistic forecasts, and economic indicators seemed to support these claims. Confidence was high, almost intoxicating. People felt that the economy was bulletproof. Families borrowed more money, companies expanded, and investment banks created riskier and riskier products, all in the name of growth and profit. Yet, beneath this surface of prosperity, cracks were forming. Housing prices were rising faster than wages, and many loans were given to people who might not be able to repay them. These risky mortgages were not just a problem for the borrowers. They posed a hidden threat to the banks and investors who had purchased MBS and CDOs. Complex financial engineering, intended to distribute risk, had instead created a vast, interconnected web of vulnerability. Each loan, each mortgage-backed security, and each collateralized debt obligation was a thread in a massive financial tapestry that, if pulled, could unravel the entire system. Meanwhile, the global economy was becoming increasingly interconnected. European banks were investing heavily in American real estate-backed securities. Asian investors were buying US mortgage bonds, believing that the American housing market was a safe bet. The financial world had become a tightly knit network. The success or failure of one system had the power to affect countless others around the globe. But this interconnection also meant that a shock in one corner of the world could ripple across continents, threatening economic stability everywhere. People lived their daily lives largely unaware of the ticking time bomb. Families worried about day-to-day expenses, planning vacations, and saving for college, never imagining that the very foundation of their financial security could collapse. Bank employees, traders, and executives continued to work, motivated by bonuses and profits, often ignoring the underlying risks. Governments monitored the economy, but the complexity of the financial products and the sheer scale of the housing boom masked the danger. It was a world of apparent confidence, but one built on fragile foundations. The stage was set for a crisis, though almost no one knew it yet. Little did they realize that in a few short years, the calm would shatter and the world would face one of the most dramatic financial upheavals in modern history. The warning signs and the ballooning bubble. By the mid-2000s, the American housing market had transformed into a seemingly unstoppable force. Prices were climbing steadily, sometimes even faster than anyone had imagined possible. Home ownership had become more than a dream. It was a ticket to prosperity, a chance to secure wealth for the future. The streets of cities like Phoenix, Las Vegas, and Miami were lined with new homes, each more luxurious than the last, all built on the assumption that property values would never fall. Banks and lending institutions, sensing opportunity, began to relax their standards. Previously, loans were given to individuals with stable income, good credit history, and a plan to repay. But now, lenders were offering mortgages to individuals whose incomes were unstable, whose credit scores were poor, or who had no steady employment. These risky loans, labeled as subprime mortgages, were bundled together and sold to investors as seemingly safe investments. On paper, the risk was minimized. In reality, it was being pushed out of sight, hidden beneath layers of financial engineering. Enter the world of mortgage-backed securities, MBS. Banks took thousands of these subprime loans and grouped them into investment products. These securities were then sold to investors around the globe, who were told that their money was secure because it was spread across numerous mortgages. What investors didn't fully realize was that the underlying loans were often highly risky, and if even a small portion of homeowners defaulted, the entire structure could collapse. It did not stop there. A more sophisticated financial instrument, the collateralized debt obligation, CDO, took these mortgage-backed securities and divided them into tranches, slices of risk ranging from low to high. Investors could buy into the safest tranches, reassured by ratings agencies that these products were nearly risk-free. Meanwhile, the riskiest tranches were still being sold, repackaged, and passed along to other financial institutions. Each CDO contained hidden layers of vulnerability. The system appeared stable, but in truth, it was a fragile house of cards, stacked high and teetering on the edge. As the bubble inflated, a dangerous complacency took hold. Many experts began to warn of unsustainable growth, pointing out that housing prices had risen far beyond historical averages, and that many homeowners had borrowed far more than they could reasonably repay. But their warnings were largely ignored. Investors were seduced by the promise of high returns, banks were motivated by record bonuses, and consumers were captivated by the illusion of infinite prosperity. There was a pervasive belief that the housing market was immune to downturns. Financial institutions were also connected in ways that were not immediately visible. Banks, hedge funds, insurance companies, and pension funds around the world held similar mortgage-backed assets. The failure of one large player could trigger a cascade of losses across the entire financial system, and yet, the complexity of the instruments made it almost impossible for outsiders, and even many insiders, to fully understand the exposure. The warning signs were there, but they were hidden beneath layers of jargon, spreadsheets, and confidence. Meanwhile, Americans continued to live as though nothing was wrong. People refinanced their homes, took out second mortgages, and invested in real estate as if prices would never fall. The social and cultural narrative reinforced this belief. Everyone was winning, and the economic engine seemed unstoppable. Yet with each passing month, the bubble grew larger, more unstable, and more dangerous. In hindsight, the signs were unmistakable. Risk was being ignored, complexity was masking danger, and the system had become over-leveraged. But at the time, the world was captivated by the promise of growth, blinded by short-term gains, and lulled into complacency. Few truly grasped the magnitude of the storm that was quietly brewing just beneath the surface of record-breaking profits and booming real estate. As 2007 drew to a close, cracks began to appear. Subprime borrowers started defaulting, housing prices plateaued in some regions, and the first tremors of a financial crisis began to shake investor confidence. These early signs were small, almost invisible to the general public, but to the trained eye, they were ominous signals. The bubble had grown too large, and it was ready to burst. The world was standing at the edge of a precipice, and nobody fully realized it. The stage was set for one of the most dramatic economic collapses in modern history, one that would touch the lives of millions and reshape the global financial system forever. Lehman Brothers and the triggering events. By the summer of 2008, the cracks that had been forming for years were beginning to widen into chasms. The subprime mortgage defaults that had quietly begun in 2007 were escalating. Banks were discovering that the supposedly safe mortgage-backed securities they had purchased were far riskier than anyone had imagined. Confidence was faltering. Liquidity was drying up, and a sense of unease began to ripple through financial institutions worldwide. At the heart of this storm was Lehman Brothers, a venerable Wall Street investment bank with a history stretching back 158 years. Lehman was a symbol of American finance, respected, powerful, and deeply connected. But beneath its polished image, Lehman was heavily exposed to the collapsing housing market. The bank had invested billions in subprime mortgages and related derivatives, and as defaults mounted, these assets began to lose value rapidly. The house of cards was teetering. Executives at Lehman, were aware of the danger. Internal meetings were tense, analysts were worried, and emergency strategies were discussed behind closed doors. Yet, despite the looming threat, there was no clear solution. Attempts to raise capital and find buyers for parts of the business failed. Every option seemed to crumble under the weight of market panic. The financial community watched nervously as the bank struggled to stay afloat. September 15, 2008, arrived like a thunderclap. Lehman Brothers filed for bankruptcy, the largest in US history at the time. The news sent shockwaves through global markets. Stock prices plunged, credit markets froze, and panic spread like wildfire. The interconnectedness of modern finance meant that losses at Lehman did not stay confined to the bank itself. Hedge funds, European banks, insurance companies, and even pension funds found themselves exposed to toxic assets they hadn't fully understood. One collapse triggered another in a terrifying chain reaction. The term domino effect was no exaggeration. Financial institutions that had relied on Lehman for overnight lending or investment agreements suddenly found themselves vulnerable. Credit lines evaporated, trust eroded, and institutions that seen strong moments before now faced existential threats. The panic was contagious. Traders on Wall Street, hearing the news, rushed to adjust their positions, sell assets, and minimize exposure, inadvertently fueling the market's free fall. Amid the chaos, the human element cannot be ignored. Employees at Lehman Brothers, many of whom had spent decades building careers at the firm, watched their livelihoods vanish almost overnight. Families dependent on these incomes were suddenly uncertain about their financial future. Across the country, ordinary people who owned stocks or retirement funds tied to banks and investment companies watched their savings dwindle in real time. The crisis was no longer an abstract concept. It was personal, immediate, and frightening. The collapse also sent shockwaves internationally. European banks, heavily invested in American mortgage-backed securities, faced enormous losses. Asian financial institutions that had bet on the continued growth of US real estate were caught off guard. The interconnected nature of global finance meant that Lehman's failure was not just an American problem, it was a worldwide emergency. Economies that were already fragile or dependent on export markets in the US braced for impact. In the immediate aftermath, policymakers scrambled to respond. The Federal Reserve and U.S. Treasury officials understood the magnitude of the threat. They watched as credit markets seized up, banks teetered on the brink, and global confidence faltered. The fall of Lehman Brothers had transformed a growing financial problem into a full-blown crisis, demanding unprecedented government intervention. Yet even in the midst of panic, lessons were emerging. Investors began to question the assumptions of infinite growth and risk-free profits. Regulators started to recognize the systemic vulnerabilities that had allowed Lehman's collapse to have such a profound effect, and the public, witnessing the human and economic toll, gained a new appreciation for the fragility of modern financial systems. Lehman Brothers' fall was more than just the bankruptcy of a single institution. It was the ignition point of a global financial conflagration, a vivid demonstration of how deeply intertwined our economic world had become, and a stark reminder of the consequences of ignoring warning signs for too long. The stage was now set for the next chapters of the crisis, where the repercussions would extend far beyond Wall Street and touch the lives of millions around the globe. Global impact and human stories. As the shockwaves from Lehman Brothers' collapse spread, the financial tremors were felt far beyond the borders of the United States. Cities in Europe, Asia, and even parts of South America braced for impact as banks discovered that they too were deeply exposed to U.S. mortgage-backed securities and other complex derivatives. What had begun as a domestic housing problem in the United States had, in a matter of weeks, become a global financial crisis. In Europe, major banks such as Germany's Commerzbank and the United Kingdom's Royal Bank of Scotland faced sudden liquidity shortages. Investment portfolios that once seemed solid were now riddled with toxic assets. The interbank lending market froze as trust evaporated, making it nearly impossible for banks to borrow money from one another. Governments intervened, providing emergency liquidity and guaranteeing deposits. But the fear of collapse hung over the continent like a dark cloud. In Asia, economies heavily dependent on trade with the United States began to falter. Countries like China, Japan, and South Korea saw their exports decline sharply as American consumers, facing uncertainty, curtailed spending, factories slowed production, and unemployment began to rise. Even in regions less directly connected to American markets, the ripple effects were felt through reduced investment, currency fluctuations, and volatile stock markets. But beyond the numbers and the economic jargon were real human lives, stories that illustrate the personal toll of the crisis. In Detroit, a family who had purchased a home at the peak of the housing market found themselves unable to keep up with mortgage payments. Foreclosure notices arrived in the mail, and despite desperate attempts to refinance, they lost the house they had dreamed of owning. Across the country, millions faced similar heartbreaks, with savings, retirement funds, and investments vanishing almost overnight. Workers in the financial sector were not immune either. Employees at investment banks, insurance companies, and hedge funds who had thought their positions were secure suddenly found themselves unemployed. For many, this was not just a loss of income, but a loss of identity. The Wall Street suits, who had once navigated billion-dollar deals with confidence, now joined long lines at job centers or struggled to re-enter a shrinking labor market. Communities that relied on stable employment were particularly hard hit. In towns dependent on manufacturing, construction, or finance, families confronted both economic and emotional strain. Local businesses, already vulnerable to declining consumer spending, shuttered their doors. Schools and public services faced budget cuts as tax revenues plummeted. Social unrest quietly simmered, fueled by anxiety, uncertainty, and the stark contrast between the prosperity of the past and the stark reality of the present. Meanwhile, social safety nets were stretched thin. Food banks, unemployment offices, and community organizations faced unprecedented demand. Volunteers and local leaders worked tirelessly to provide support, but the scale of the crisis revealed the fragility of societal systems in the face of a global financial collapse. Stories emerged of neighbors helping neighbors, of communities rallying together, and of individuals finding resilience and ingenuity amidst adversity. In Latin America, countries with economies tied closely to exports and international investment also felt the tremors. Argentina, Brazil, and Mexico experienced declines in foreign investment and currency volatility. Governments were forced to implement emergency measures to stabilize their economies, often relying on international aid or loans from institutions like the International Monetary Fund. The crisis highlighted how deeply interconnected the global economy had become. A problem in one sector of the world could rapidly propagate across continents, touching lives far from its origin. The human impact was not just financial, but emotional. Anxiety, stress, and uncertainty became pervasive. Families postponed plans, individuals delayed career moves, and consumers reduced spending. The narrative of relentless growth and upward mobility that had dominated the early 2000s was replaced by fear and caution. Yet even in the darkest moments, there were glimmers of hope. Communities organized support networks, innovative solutions emerged, and people began to rethink their relationship with money, risk, and security. Ultimately, the global impact of the 2008 financial crisis underscored a crucial lesson. In a tightly interconnected world, economic decisions made in one corner of the globe can have far-reaching consequences. It was a stark reminder that finance is not abstract numbers on a screen, but a web of human relationships, trust, and consequences, capable of shaping entire societies in profound ways. Government interventions and recovery. As the financial crisis deepened, governments around the world faced an unprecedented challenge: how to stabilize an economy that was teetering on the brink of collapse. In the United States, the Federal Reserve and the Treasury Department recognized that immediate and decisive action was necessary to prevent a total meltdown. The collapse of Lehman Brothers had already demonstrated how quickly fear and uncertainty could freeze credit markets and disrupt the flow of capital. The Federal Reserve acted swiftly, lowering interest rates to near zero in an effort to encourage lending and spending. Emergency liquidity was injected into banks to ensure they could continue operations and meet obligations. At the same time, Congress passed massive bailout packages, providing funds to stabilize major financial institutions and prevent the collapse from spreading further. These measures were controversial, with critics arguing that they rewarded the very institutions that had caused the crisis. Yet, without these interventions, the entire financial system might have unraveled. Internationally, similar steps were taken. European central banks coordinated to provide liquidity and stabilize their own banking sectors, while governments guaranteed deposits to prevent bank runs. In Asia, policymakers worked to protect export-driven economies from the cascading effects of reduced American and European demand. Across the globe, the message was clear: Extraordinary times required extraordinary measures. The interventions began to show result, though recovery was slow and uneven. Stock markets gradually regained some confidence, credit started flowing again, and banks stabilized. For many Americans, however, the damage had already been done. Families who had lost homes or jobs faced a long road to rebuild. Trust in the financial system had been shaken, and the psychological impact lingered far beyond the immediate economic indicators. Yet amidst the hardship, important lessons emerged. Risk management became a central focus for financial institutions, highlighting the dangers of unchecked leverage and complex derivatives. Regulatory reforms were proposed to increase transparency, ensure adequate oversight, and prevent the excessive risk-taking that had fueled the crisis. Governments recognized that a stable economy required not only strong institutions, but also safeguards to protect ordinary citizens from systemic failures. The recovery phase was also a testament to resilience and adaptation. Communities came together to support those most affected. Businesses restructured, and individuals re-evaluated personal finances, savings, and investments. Slowly but surely, the global economy began to heal. The crisis had exposed vulnerabilities, but it also sparked innovation, reform, and a renewed understanding of the interconnectedness of modern financial systems. Ultimately, the government interventions and recovery efforts were a crucial turning point. They did not erase the pain or undo the losses, but they provided the scaffolding necessary for rebuilding. They demonstrated that, in the face of systemic risk, coordinated action, decisive leadership, and a willingness to confront difficult realities could avert an even greater catastrophe. The 2008 crisis was a harsh teacher, but it offered invaluable lessons for the future. That vigilance, transparency, and proactive governance are essential to sustaining economic stability in an interconnected world. Lessons learned and conclusion. The 2008 financial crisis left an indelible mark on the world, reshaping economies, governments, and individual lives. Yet, beyond the immediate devastation, it also provided invaluable lessons that remain relevant today. By examining the mistakes, the warning signs, and the responses, we can begin to understand how the world almost collapsed and how to prevent a similar disaster in the future. One of the clearest lessons is the importance of risk management. The crisis exposed how unchecked leverage, complex financial instruments, and the lack of transparency can create a fragile system. Institutions that appeared robust on paper were, in reality, vulnerable to a chain reaction triggered by even minor shock. Today, regulators and banks place far greater emphasis on understanding the risks inherent in every loan, investment, and derivative, striving to prevent hidden vulnerabilities from spiraling out of control. Another critical takeaway is the value of transparency and accountability. Many investors and institutions trusted financial products they did not fully understand, often relying on ratings agencies or the assumptions of others. The lesson is clear: no matter how sophisticated a system appears, it must be transparent, and those responsible for managing it must be held accountable. Blind trust can have devastating consequences. The human dimension of the crisis also cannot be overstated. Millions of families faced foreclosure, unemployment, and financial insecurity. The crisis was not just about numbers on a balance sheet. It was about people's lives, dreams, and futures. Economic policy and regulation just consider this human impact, ensuring that systems are designed not only for efficiency and profit, but also for resilience and fairness. Global interconnectedness was another key lesson. A crisis that began in the US housing market quickly spread to Europe, Asia, and beyond. In our modern, interdependent world, economies are tightly woven together, and a failure in one sector can ripple across continents. International cooperation, coordination, and early warning systems are now recognized as essential to maintaining global stability. The crisis also highlighted the importance of personal financial literacy. Many individuals were caught off guard, lacking the knowledge to make informed decisions about mortgages, credit, or investments. Today, financial education is more widely emphasized, encouraging people to understand not just how to grow wealth, but how to protect it, manage debt, and prepare for uncertainty. Finally, the 2008 crisis served as a reminder that no system is infallible. Confidence can evaporate, markets can fail, and institutions can collapse. The story of 2008 is ultimately a story about vigilance, humility, and the recognition that economic prosperity is fragile. By learning from past mistakes, society can build stronger systems, more robust safeguards, and a culture that values caution alongside ambition. As we reflect on the crisis, one truth becomes clear: history may not repeat itself exactly, but patterns do. The 2008 financial crisis is not just a tale of loss and failure. It is a story of resilience, adaptation, and learning. It reminds us that even in the face of seemingly insurmountable challenges, humanity can survive, rebuild, and emerge wiser if we choose to learn from the past. Thank you very much for watching this video. Follow us and don't forget to subscribe. We look forward to your suggestions and requests in the comments.